Why do traders spend so much time staring at little candles on their screens? These peculiar bars seem simple enough, just a thin vertical line with a cross at each end, right? But there's actually a whole world hidden behind those lines that can tell us so much about the stock market. Let's peel back the layers. Imagine you're looking at a candlestick chart like it's a weather report for the market. Each candle is like a day in your life, bright and sunny or dark with storms brewing. The thin vertical line shows how high the price went during that period, while the cross marks show the opening and closing prices. And here's the surprising part. These little candles can reveal whether the market was bullish, positive, or bearish, negative. A green candle with a longer body means prices closed higher than they opened. Traders were optimistic. Red or black candles mean the opposite. They close lower, signaling pessimism. So why do traders get so worked up over these things? Because each candle is like a snapshot of that day's battles between buyers and sellers. The opening price is the starting point. The cross on top shows where prices rallied to, and the bottom cross marks their ultimate retreat or advance by closing time. Okay, so let's dive into candlestick charts. You know those waxy little things you see on your screen? Well, think of them like weather reports for the market. Each one tells a story of buying and selling action. Here's how it works. Imagine you're looking at the day's weather forecast. A sunny day means good weather, right? In a candlestick chart, a green or white candle is like a sunny day. It tells us that more people bought than sold during that time period. The market closed higher, like the sun coming out and making everyone happy. Now, here's where it gets interesting. A red or black candle is like rain in your weather forecast. It means that more people were selling than buying. The market closed lower, just like when you wake up to a rainy day. And if the candle has a little tail on top or bottom, like a lightning bolt sticking out of a storm cloud, that's called a shadow. Shadows show us how much bidding and asking happen outside the closing price. For example, if there's a long upper shadow, it means buyers tried really hard but couldn't push the price up as high as they wanted. So, in summary, each candle is like a weather report for that day's market action. Green candles are happy days when more people bought. Red ones are rainy days when sellers had the upper hand. And those shadows show us what was happening around the closing price. All right. So you've got the basics of candlesticks down, opening and closing prices, wicks that show how much the price moved around during the day. But have you ever noticed those long shadows above or below the body? They might seem like just extra lines, but they actually tell us a story about what was really happening in the market. And here's the surprising part. Those long shadows are telling us when buyers and sellers tried their hardest to push prices in one direction, but couldn't quite make it happen. Let's break this down with a simple analogy. Imagine you're playing a game of tug-of-war. In this game, think of the price as a rope and the buyers and sellers as two teams pulling on either end. When the rope ends up right in the middle, let's say at $50, a candlestick forms with no real shadows because there wasn't much tension between the teams. But now imagine that one team really wants to pull the rope all the way down to, let's say, $48, but they just can't quite get it there. The sellers are doing their best, and you see a long shadow above the closing price at $50. This is telling us that lots of buyers try to bring the price down, but the sellers were resilient and kept pushing back. So, even though we ended up with an overall close of $50, those buyers were very active, and the market didn't move as much as it could have. Similarly, if you see a long shadow below the closing price, that means the buyers are giving their all to push the price back up, but the sellers are holding strong. This is like one team trying really hard in tug-of-war, but just not quite enough to win. So, those long shadows aren't just extra lines. They're a window into the battle between buyers and sellers. They tell us that the market wasn't as settled as it might seem by just looking at the closing price alone. And here's the key takeaway. When you see a candle with long upper or lower shadows, pay attention. It means there was significant pressure from one side, but not enough to change the overall direction of the market. These are the signs that traders look for to understand what's really going on behind the scenes. And here's the surprising part. It's not just about where the market ends up. You need to look at the body of each candlestick to understand who had more power during that trading period. Let me break this down for you. Imagine you're playing a game with your friend, and you both take turns flipping a coin. The result of the last flip is like the market's final price, whether it lands on heads or tails. But what if we could see which player had more force during each turn? That's where the candlestick body comes in. In a bullish candle, which looks like a green or white rectangle, the body represents the range between the opening and closing prices when buyers were stronger. If the market opened at 9 a.m. and closed higher by 3 p.m., that big green rectangle tells us there was more buying pressure throughout the day. It's like saying players on this team pushed really hard to win. Conversely, a bearish candle, which looks like a red or black rectangle, shows when sellers were in control. If the market opened at 9 a.m. and closed lower by 3 p.m., that red rectangle indicates more selling force during that period. It's as if the other team just wouldn't give up. Now, here's something you might not know. An inside candle is like a tie game where players keep even score. The body of this candle shows little to no movement between the opening and closing prices, meaning buyers and sellers were evenly matched all day long. So, when you see that green rectangle, it's not just about where the market ended up. It's also telling you that the buyers had more power throughout the entire trading period. And the red ones? They show us that sellers dominated. Understanding these bodies can give you a clearer picture of what really happened during each session. It's like knowing which player tried harder in each round of your game, even if the final result was the same. So far, we've learned that the body of the candlestick shows us whether buyers or sellers had the upper hand, like a tug-of-war match. But there's more to it than just that. Let's put everything together and see how these little bars can paint a comprehensive market picture. Imagine you're playing a game where each turn, you and your opponent make moves on a board. The candlestick chart is like recording those turns. Each candle represents one of your turns. Let's say the period between 9 a.m. and 10 a.m. The body of the candle tells us who won that round. If it's white or filled in like a green light, buyers had more power, pushing the price up. If it's black or hollow, like a red light, sellers were stronger, pulling the price down. Now, why does the wick matter? Well, think of the top and bottom of the candle as the high and low points you reach during that turn. The longer the wicks, the more extreme those highs and lows were, like if there was a sudden spike or drop in the middle of your game. Let's take it a step further. The shadows, the thin lines outside the body, are like the moments when things got really tense. The top shadow shows how close you nearly won, and the bottom shadow reveals how close you nearly lost. Together with the main part of the candle, they create a full picture of what happened during that turn. For example, let's say we have a candle where the body is black with long wicks. That tells us sellers were in control at first, causing prices to drop sharply, but then buyers fought back and pushed the price up again before the end of the period. It's like a roller coaster ride. Fast drops and quick climbs. Now, when you see several candles lined up, it's like watching a movie where you can see the overall trend. If most of them have white bodies with short wicks, that means buyers are in charge, driving prices up over time. If they're mostly black with long wicks, sellers are winning, pushing prices down. In summary, candlestick charts aren't just about who won. They tell a story, up and down, tension and resolution, in the form of little bars. By piecing together all those parts, you can see not only what happened, but also how it happened. All right, so we've talked about candlestick charts being like little war zones on a map, each candle showing the battle between buyers and sellers, with wicks and shadows marking their skirmishes. But you might be thinking, are these charts really that useful, or are they just fancy graphics? Let's break it down. Candlestick charts aren't fortune tellers. They can't predict the future like a crystal ball. Instead, they give us a snapshot of what's happening right now in the market. They're like a live feed from a battlefield, showing us who's winning and losing. Just take a look at the body of the candle. This shows you if buyers or sellers were the stronger force that day. A solid green or white candle means buyers won. The closing price was higher than the opening. On the flip side, a red or black candle tells us sellers dominated, and the closing price fell below the opening. Now, here's the surprising part. Those wicks and shadows? They're like battle lines. The upper shadow shows how high prices went but didn't stick, like when an enemy attack was repelled. And the lower shadow shows where prices dropped low but bounced back, like a counteroffensive. So, while candlestick charts can't predict tomorrow's market movements, they do tell us what's going on today and in recent days. They help us understand the forces at play and spot patterns that might indicate future trends. Remember, just because we see a long red candle doesn't mean prices will keep going down forever. It simply tells us sellers were dominant that day. And when buyers get strong after a loss, it's like they're building up their army for a comeback. If you understand these charts and use them as tools to watch the market dynamics, instead of trying to get rich quick or predict exact prices, you'll be better equipped to make informed decisions.